Hello everyone, welcome to Officer 24/7. My name is Niharika Ma'am and I'm with you with the specific area of ABFM. We are introducing our specific series regarding the specific area of the 10 minutes concept show. See, you're preparing for your ABFM examinations. There are certain chapters which are slightly very important or more important than others. So I'll be talking about those concepts in detail with all of you in these particular concept shows. So let's talk about the specific area of financial leverage. Okay, everyone, this is the particular topic that we are going to pick up today. What do you mean by the term leverage first? When you talk about the term leverage, leverage is basically something which is boosting your um, overall income or basically your organization altogether, right? That is how we define the term leverage, right? So when we talk about leverage, what happens here? There are multiple ways of increasing your income. One is by introducing whatever scale of operations we are working at. We are trying to have more sales at that point of time. Whatever we are producing, we want to increase more sales. Then what will happen is our income will increase at the present level of operations. Once we think about, nahi, let's start producing more to have more sales. That is where we talk about financial leverage. So when we talk about the financial leverage altogether, this is a strategy to enhance the returns for the equity shareholders by using borrowed funds. Obviously, there's a limitation of using your own funds. So once your funds has a limitation, what will you do? You will get the funds from somewhere else. So borrowing money from somewhere else just to boost your present level of operations is something that we call as financial leverage. In this case, what happens is once the organization start making a good amount of money, then what will happen? The earning per share will increase. Earning per share matlab the portion that the particular people will be getting out of it. Okay? That is earning per share is per share income. So this is, but they also have to look forward to understanding the risk that must be carefully managed. Nobody wants to have a lot of risk. Na? They want to reduce their risk. That is what they look forward to. Done. In terms of financial leverage, what happens is financial leverage uses borrowed funds to enhance return on equity investments. Basically, what do? You want to increase your funding, right? You want to make your business better, but for that, what will you do? You have to bring more money, and sometimes your money is definitely not available, or your money has a specific limit as well. When our funding is not that much, so what will we do? We will arrange our funds from the borrowings, from the loans that we take. So what do we do in this case? The goal is to increase per share income. Acha everyone, if the organization is earning 10 rupees, then it is split between 10 people, everybody is getting 1 rupee. Now once the companies start making 20, the number of people are still 10. That means their earning has now doubled. So basically what do you want? That every shareholder gets as much as possible, right? And then we have mechanism. How do you increase your overall operations? That is, whatever debt you take, you use this debt in your business to grow further. Once your business grows further, what will happen? Your asset values is basically going to be increasing further, your business will increase further, and your income is going to increase further as well. So assuming the borrowed funds cost less than asset value, it's obviously sometimes the borrowings are slightly cheaper as compared to any other form, because in this case you have to pay a specific amount of interest and the story ends there. There is nothing like the person will have voting rights, he has a right over your organization, nothing of that sort. So in this case they have an edge, that whatever money that you borrow from someone, at least you don't really have to worry about you losing your decision making for them. Then what are the benefits of this? Basically what happens is once you start making good amount of money from the risk that you have taken, your income increases, your shareholders will be more happy, right? So in this case it allows the expansion without diluting ownership. If you are the owner and there are a little more number of owners, so all those owners together will balance it out. Then higher interest rates. So there's one problem there. When we talk about risk there, I think I was just recently reviewing somewhere and I got a message from somewhere that from this bank, if you take a loan, the interest is 0.99 per month, everyone. if it is around 0.999, maybe it's around 12%, you know, just a little less than 12%. It is, isn't it very high? If you're talking about interest rate, this is not a very affordable interest rate, you know. So basically, when you take loans, one particular thing that you face is in the commercial market, your loans are not as easily available as to a residential properties or resident or a person's personal usage money based. So when we talk about the risk associated is very high. Reduced cushion for adverse events and their potential earning per share. Reduction if poorly managed. So whatever you are earning, your earnings will go down if you do not properly manage your business. Then, okay, look at this important part, everyone. In the financial leverage, they have given all these specific ratios. Let's look at it. The first ratio is debt to asset ratio. Just look at the name of the formula and you will come to know which is numerator and which is denominator. Debt means total debt and asset means total asset. How much part of your assets is made from the debt that we have taken? That is total asset to debt ratio. Total debt to asset ratio. Then debt to equity ratio. This is a super duper important ratio, everyone. Which portion of your business is built with your money and which portion is built by outsider funding, right? So in this case, total debt divided by total equity. This is owner funds and this is outsider funds. Next is debt to EBITDA ratio. What is EBITDA? This is earnings before interest, tax, depreciation, and amortization. Done. So when we talk about this area, we are going to take up all these earnings before adjusting all these specific terms, the EBI, TDA, right? And then we have a specific ratio called interest coverage ratio. Whatever earnings you have made before this interest divided by whatever interest you are paying currently. On this basis, you can easily find out the funds that you have putting into the business, whether your earnings are good enough to pay off the interest as well as principal, or you cannot afford to pay it back, right? This brings that clarity. And then is equity multiplier. Debt is basically total debt over assets, and then we have total assets upon equity. Portion of business which is built with equity, portion that is built with debt. Okay, done everyone. And then comes the specific formulas for degree of financial leverage. When we are talking about the specific increase in our financial leverage, increase in our loans we are looking forward to, right? Or we are looking at increasing our business operations altogether. In this case, how do they work? The ratio of percentage change in EPS. One is percentage change in EPS divided by percentage change in EBIT. Next is degree of financial leverage. This is how they've written it. Change in EPS divide by EPS. This is into 100 and this will give you the percentage. Change in EBIT divide by EBIT in percentage and you will get the formula. Last formula is you take your EBIT upon EBT. Did you notice that when we try to look at the particular rhyme schemes, they are very similar. EBIT, EBT. Done? In this case, the formula is EBIT upon EBT. Now, based upon this formula, everyone, how does it work? Look at this part. If you have this formula, there are certain important things that you have to remember. First is no fixed interest. If there is no fixed interest that you have to pay, then there is no leverage effect. Leverage is basically when you take loans. If you do not take loans, then this will not affect your money. Then if you take loans, then what will happen? Your degree of financial leverage will go up. Amplified EPS, because more money coming into the business, more income for the shareholders. break even point at this point of time, whatever new money that you're bringing in the business is basically used to pay off your loans as well. So this is undefined. And when below the break even point, when it is negative, that means at this point of time you have basically affected your organization as well as the organization which is helping you. In this case, when you talk about the EBIT, how do they calculate it? From your sales value, remove only the variable cost. What you're left with? Contribution. Now, first of all, remove your variable cost. Second, remove your fixed cost. This is what will give you earning before interest and tax. Then, first of all, EBIT. First of all, remove your I, then remove your T. And that is how you get the area of A, and T. Once you have paid the tax, it becomes the money that you're left with after tax. So it is basically over the period of time, this will turn into uh, a specific area where there's a calculation of your earnings overall. Okay. Based upon this, here's a question, everyone, from our book. Let's quickly deal with this question to understand the topic. You have your sales of 24 lakh. Your sales comes out to be rupees 24 lakh. Then everyone, from this remove your variable cost. Variable cost is 50%. That comes out to be 12 lakh. You're left with 12 lakh rupees. Now, what do they say? They said this was variable cost was 50%. Then fixed cost of rupees 10 lakh. Fixed cost of 10 lakh rupees, matlab no matter what you are doing, this is the specific money that you have to pay. So in this case, what will you do? First of all, you remove the variable cost and you remove the fixed cost. Fixed cost was of 10 lakh. So in this case, what are we left with? 2 lakh. Then everyone, this is your earning before interest and tax. Now, in the question, they have asked upon EBIT upon EBT, financial leverage. Now, so how do we find it? Look at this. They have borrowed 10 lakh rupees at the rate of 10%. 10 lakh rupees at the rate of 10%, matlab, what is your amount of interest, everyone? The interest is going to be 10 lakh into 10%. That means this should be 1 lakh. So from 2 lakh, remove the next 1 lakh. Till now, you are done, everybody. This is how you find your earnings before interest and tax and your earnings before tax. Once you have calculated it, acha, there is one more point. They have also said about taxation from this EB earnings after. This is earning before tax. This is after interest, before tax, and then also remove your tax. Tax is 50%, everyone. Out of 1 lakh 50,000 is gone. Whatever they are left with, they are multiplying, dividing, whatever they are dealing with. Now, whatever you are left with is used in the business. You know? So financial leverage helps you to find out whether the business is growing perfectly or you have to take money from somewhere else to keep it running. Then everybody saw the particular point there. This is EBIT upon EBT. So this is where I end this session, everyone. I hope this session was helpful. This is regarding financial leverage. Now we'll be meeting in the next session. Thank you so much.